Good morning. Can you hear me? Thank you very much, Alberto. Thank you. And can you see the presentation? Excellent. So we're gonna experience a new way to do lectures because I can't see the presentation. So I will flip the slides for your benefit, and I have my iPad where I can double check whether we are connected on the same page while I talk. Okay. If you have any problem or you can tell that there is some disconnection, please do tell me, because unfortunately I can't see the presentation myself here from London. So it's a new experience. It's like to be blind. I hope you don't mind. I'm recording, so if you agree, we can start with the session. So can you please confirm once again that you can see me and that you can hear me very well? Excellent, excellent. So today we are starting, the session related to the mergers and acquisitions. We have an introductory session today on the topics. And then after Easter break, together we will have a number of sections that are organized as follows. I want to share with you my thoughts and experiences on how to organize an M&A process. And we will talk about M&A process in the context of the sale of Candy. Candy is a white good producer that has been sold to Haier, a Chinese player. It's a transaction that I led the execution with my team. Then in the second session, we will have how to originate and execute transaction, M&A transaction in pandemic period, in pandemic area. And we will be talking about the investment of Ron Group, which is a private equity company, into Illy Cafe, which is probably the most well-known brand in the coffee business. We will talk in the third section about hostile takeovers, and we will talk about the transaction Intesa Ubi that took place last spring in 2020 in Italy. Then there will be the last two sessions where we'll share views and thoughts and lesson learned in the big trip from Fiat to FCA to Stellantis. In other words, the history of Fiat, that used to be called Fiat, from 2004 till now, the evolution of this group through a number of transactions, the acquisition of Chrysler, the IPO of Ferrari, and then ultimately the merger with Peugeot. So it is a very intense program, but I think we will enjoy it. Okay, let's talk about M&A. Mergers and acquisitions de facto are, in my mind at least, one of the most important product in investment banking, because it's the more complicated, it is the most complex, is the most attached to the heart and the brain of CEOs, because it is the most important transaction and product associated with the ultimate and overall strategy of a corporate. You do M&A to acquire a competitor, to diversify your geographical footprint. You do M&A to to be more laser focused on your own core business and by selling and no core business any longer. In other words, every time there is an M&A transaction, which means the transfer of control of an asset of a corporate from one owner to another, every time there is an M&A transaction, it is a strategic moment. It is a transformational moment. It is a catalyst within the organization that involve all part of the business, all part of the organization, because it means, you need to plan the transaction, you need to originate the transaction, you need to execute the transaction, and then when you buy a company, you need to integrate it. It means that the different company, merge together, people, teams, information technology is a very invasive moment in the company history. You can do an equity transaction that is very important, but is not as invasive as an M&A transaction. You can have a debt capital market transaction, very important, but not as invasive as an M&A transaction. Every time there is an M&A, it is like, an event that drives the company into a different territory. Today, if you see the presentation in front of you, and let me try the experiment. Okay, so let's go to page 3. Here are the volume in M&A transaction from 2009 to 2020. So I wanted to show you how big is the phenomenon of M&A, because let's call it last year in 2020, transactions globally were $3.6 trillion. And let me do a step back for a second. Last year was an important year because, we had COVID, we had the pandemic impact in the marketplace, and we made a lot of analysis on trying to understand which could have been the impact of M&A on the M&A market of the pandemic virus. And we have analyzed approximately 30 years of business. And basically, we have identified 4 big crises. We have identified the crisis of oil crisis in the early 90s, the crisis of .com in early 2000. Then there was the global financial crisis in 2007, 8, and 9. I mean, 7, 8, and 9, because started in US in 2008 and took place more in 2009 and 10 in Europe. So it was a long crisis. And finally, in 2020, we had the COVID crisis. Basically, we have 2 kind of event driving this kind of crisis. Either are crises driven by a structural change, and like a global financial crisis where there was a drawback in liquidity, the banking system stopped to function, and the economy de facto got frozen, and there was a structural change in the business. And as a result, the crisis was deep, but when it's structural, it is also long in terms of duration, and is very long in terms of recovery. And look at what happened. Look at 2009 volume, at the bottom of the page, you see that the volume were 2.3, then 2.7, then 2.8, then a small drop, and then a grow again. In other words, it took more or less, let me do the calculation, 6 to 7 years to go back to the peak once again. Okay? So the first lesson is, when you have a crisis that is driven by structural changes in the economy, the crisis is deep, yes, but it also takes a lot of time, more or less 5 to 6, even sometimes 7 years, to go back to the peak of activity. While on the contrary, when the crisis is driven by a shock, and in this case, like the oil crisis in the early 90s, or in the case of the pandemic virus, COVID, the crisis is sharper in terms of decline of the economy activity, but then there is also a quick recovery, or at least quicker than the crisis, than the structure, based on the structural changes. Okay, and you can tell in this slide exactly what I'm trying to tell you. When you look at the quarter by quarter, in the top right part of the same slide, page 3, you can see that there was a sharp decline in activity in Q1 and Q2, which are the first quarter and the second quarter in 2020, due to COVID. But then the recovery accelerated right after, immediately, as soon as the shock has been analyzed, metabolized, and internally digested by the market participant. What I'm trying to tell you is that when a crisis is due to an exogenous shock, the decline is even sharper than the structural changes, but the recovery is faster. And you can tell the volume in 2020 went down, but not as dramatically as it happened in the crisis of 2008 and 9. So in other words, the first the first set of messages that I wanted to share with you is that this COVID has been a catalyst for a crisis, but was also a catalyst for a number of changes in the marketplace that they were already there, ready and prepared to get materialized. The digitalization, the disruption in a number of industries, like financial services, like media industry, like in technology, like in national resources. And there was a crisis that has hit some industry, financial services, for example, the airline business, but has also created a lot of opportunity in other industries, like health, like technology, and so on and so forth. Because we need to remember that while the market was collapsing in some industry, there were other segments in the business and industry that they were very much growing during the same period of time. Let me pause for a second. Is clear what I'm trying to share with you, analyzing the M&A volume? So can you hear me well? I'm concerned that because I can see neither you guys nor the presentation that are driving the car in the full darkness. So I want to make sure that you are with me all the time. Excellent. I'm happy with that. So why the volume of M&A are so important? I mean, it's a very simple questions with a very simple answer. At the end of the day, volume and M&A, which, as I told you, the M&A transaction, a merger or a requisition or a sale of a company, is the most important strategic event in a corporate, are events that are telling us about the level of confidence that a chief executive officer, that the board has vis-a-vis the economic future. So when the level of activity in M&A is pretty solid, stable, and ultimately even growing, it means that the level of confidence of CEO and boards is getting higher and higher and higher, and this confidence translates into activity in the marketplace. And when there is M&A transaction, it means that there is a level of activity that extremely intense, because the M&A transaction is also heavily correlated with the GDP, either contraction or expansion. In other words, if we would have overlapped to these bars of the volume in M&A market, you would have seen that, you know, the GDP evolution would have been very much correlated with the activity. So when the volume of M&A are getting higher and higher and higher, even the expansion of the economy moves accordingly. So as you can see here, de facto, the message for you guys is 2020 is telling us that COVID has had a dramatic impact in the economic place, but is defined as a shock, for an external shock that did not affect the economic activity as seriously and dramatically and deeply as it happened, for example, in the global financial crisis, but also is paving the way for future activity in the months to come. And there will be a lot of opportunities, because the economic activity, the strategic dialogue, and the level of confidence of CEO and board in the marketplace, rather than disappearing, actually, on the contrary, is getting higher and higher. Okay? Let's see page 4 is the breakdown of the activity in the world. As you can see, in 2020, as usual, the most important market in the world is the US. And of course, in 2020, US got the most dramatic reduction because it's a big market, very reactive, very intense. So when there is a crisis in US, the crisis is severe. But when there is a recovery, the recovery is more quicker and more accelerated in US. So the weight of the M&A activity in US went down, but remains the biggest market in the world. And if you see a page 5 of the presentation, you can tell, you know, the activity by industry. And as you can see, the industry that are affected the most are TMT, particularly media, the industrial activity, you know, company in the mechanic industry, engineer, automotive, and so on and so forth, and natural resources. Again, are 3 very important industries, and tells you that the activity was not in sponsor, was not in the private equity, but was very much driven by corporate, as we can see in a few seconds. In your opinion, let's have a bit of debate. In your opinion, why media, natural resources, industrial are the industries that are affecting the most in terms of M&A? Why, in your opinion, right? You know, those transactions in those industries. It's a debate. There is nothing wrong or right. It's only a way to involve you guys, because again, I'm struggling to be alive myself with you, because I can see you, and I want to make sure that you pay attention and you are following the lessons. Okay. Yes. Basically, when there is activity in the M&A market, is because the market conditions are favorable, especially for the sellers as well. I totally agree. I totally agree. Is also because COVID intensified, emphasized some dynamics. And I agree with you, but TMT was very, very busy because telecom is very much driven by the technology, but also the media business. You need to remember that media means everything associated with media, which means Netflix, means Spotify, means um, uh, all the application of technology in the entertainment business. Think about also, TV related kind of services and so on and so forth. So because of COVID, weaker players collapsed and capitulated, and the biggest one are getting bigger and bigger. So de facto, we have COVID has intensified the competitive dynamics in the marketplace. Natural resources as well, because think about it, also with COVID, the level of activity in the commercial airline business, has disappeared. Nobody's flying any longer, at least not as frequently as it was before. The consumption of oil and gas has reduced because of the contraction of the economy. And as a result, in national resources, a lot of players have decided to expand their own business in order to buy weaker competitor, increase the market share, increase the critical mass in order to spread out the cost base to a bigger level of activity. And also because national resources is driven by other dynamics like environment and sustainability that in 2020, also because of COVID, have intensified in terms of importance, magnitude, resonance in the marketplace. So those industry, and the industrial means also health, pharmaceutical, a number of transactions that we can see in all activity in the pharmaceutical business for obvious reasons have intensified. So those are the most important contributor in the M&A. And I'm sharing with you these slides not because there is an academic relevance, but understand which are the drivers and the trends in the marketplace is helping you, in my mind, also to take important decisions once you have finalized your academic, itinerary, because you can decide what you want to do next. And in my opinion, it's useful to share thoughts on what's happening in the market because it will allow you to have a better informed decision in order to do, to make the next steps professionally. Before going ahead, I wanted to share with you also some important structural changes in the M&A market. Talking about, because it's an investment banking course, what's happening in the investment banks at investment bank levels. You remember we spent a lot of time when we have done the equity session in the first place, talking about the league table, why the league table was important in equity business, because allow a player to be more credentialized and to be in the position to market his own strengths, skills, and capability to client, and be number one or top 5 in equity league table is very relevant to get a new business. And we have seen that in order to get credit in the league table ranking, you need to do transaction as a global book runner in order to have the credit. I mean, there is a very comparable very comparable dynamics in the M&A market too. So every time you're advisor in a transaction, and to be advisor, you need to have a letter, a mandate letter that formally certified that you are formally engaged by a counterparty in that transaction. You get credit for that transaction both when it's announced and then when the transaction is closed. And you get credit both for number of deals that you make, but also for the volume of the transaction. And as you can appreciate, also in M&A, the credit and the league table fight is brutal. Brutal because if you're number one in M&A, you can claim that you have been the best advisory house in the world because you have been number one. It means that most of the company in the world has selected that company to be the advisor in a critical moment of his own life. And let me tell you the way the market is structured these days, which is very much an evolution of the crisis that we have experienced altogether in 2008 and 9 globally, the financial crisis. And in my mind, all these trends have been intensified in this crisis due to COVID. When I started my activity, de facto the M&A market globally was divided in two big families. There were the European banks and there were the American banks. And more or less, the market was divided equally between the two families. Now, I would say that the M&A market globally is totally dominated by the American banks. And these American banks are de facto, a very highly selected number of players because we got Goldman, we got JP Morgan, we got Morgan Stanley, I would say Merrill, and finally Citi. Those 5 banks are dominating the global market in M&A, and they're getting day in, day out the bigger part of the market share. And for example, while in equity, the market share is limited by the number of players that can claim the role of book runners, but theoretically you can do all the equity deals in the marketplace. So you can have, assuming that you can have only one bank that does all the deals, de facto the equity market could theoretically reach 100% market share associated with one player only. By definition in M&A, you can't do that. Because when there is a transaction, there is always a buyer and a seller. There is always when there is a merger, there are two companies. And by definition, you cannot represent both parties. So the maximum level of market share, theoretically, that you can achieve is de facto 50%. Because in any transaction, even though you are very successful, very competitive, dominating, you can't have more than half of the position, because every time you have a role, you must have another advisor on the other side. For all these reasons, the market share in M&A are even more brutal, because when you see that the top 5 investment banks are dominating almost 60 to 70% of the market, it means that the remaining part, which by definition would be 50%, is even less controlled by the weaker player. And indeed, you can see in the market that European players, even prestigious banks, very strong with a lot of history, like Credit Suisse, UBS, BNP Paribas, Deutsche Bank, and so on and so forth, are slipping down. And there is a reason for that. Because the USA market is extremely concentrated. the American banks are de facto an oligopoly that is very well functioning. And when there are few banks, the top five that I told you, that are dominated the most important market in the world, that counts more or less 45 to 50% globally, that kills competition. And indeed, the European banks are sleeping down. Why? Because they don't have, especially as a result of the global financial crisis, important footprint capability in the USA market. Within these dynamics, where the biggest players in US are dominating the market, life is always unpredictable, because there is also a phenomenon that I wanted to share with you, which is the raising role of what I call boutique, which are independent players that are not associated with big banks, but they are specialized in some specific niche, industry, or trends, and so on and so forth. And these players are becoming more and more important in the marketplace. So de facto, the erosion of the market share of the European banks is further emphasized by the players independent that I mentioned to you, like Centerview, like Yoel Zawi and Co., like Jeffries, like players like spin-off from the big banks. We had a lot of partners at Goldman's that they left Goldman Sachs after a number of years, and they decided to set up their own business. And these players are actually pretty good. They are doing a very good business, and because they are laser focused in some niche or segment of the market, they are growing in terms of importance, and they are eroding furtherly market share to the weakest player, which are the European bank. So once again, I'm telling you these kind of things because I wanted to show you how the market is structured, because you got the five top banks dominating, USA banks dominating the market. There is the rising star, trend of the boutique, and there are the top European banks that are struggling to survive and retain an important role in the marketplace for very specific reasons. Lack of USA presence, lack of capital base, expertise, and also, fragmented market share in their own domestic market. Before going ahead, do you have any questions? And please, you can do either, by raising the hands and you write, but if you want, you can step in and talk. I'm very happy with that, because we can, if we are disciplined, we can have a nice discussion. Do you have any question about what I've been sharing with you so far? Okay, everything is clear. Are you still with me? Please give me a sign of presence. Okay, excellent. The same trends, if you go to page 8, that we have experienced and seen in 2020 for globally, it is also in Europe. Europe represents more or less 30% of the activity, and here again you got a lot of activity in the corporate business, which again driven by national resources, media, telecom, healthcare. And the first additional comments that I wanted to make and share with you is what you find here in page 9. And there's a new trend that you can see in the marketplace. There is in US, but it's coming to Europe as well, and more intense than before, which is the activism, and which is the unsolicited forms of approach and aggressive bidder. For example, a transaction could be hostile, could be friendly. The definitions of hostile and friendly is only related when you approach shareholders hostilely or aggressively because you don't want to have the agreement with the management. So you don't want to negotiate in the first place terms and conditions potentially with the management because maybe you think that the management of the board is not, how can I say, supportive and cooperative. So if you decide that you have enough and you want to buy a company anyway, so you can approach in a very aggressive fashion the shareholders of the company. So you skip the dialogue with the management and with the board, and you offer something to shareholders. On the contrary, when a transaction is friendly, it means that has been agreed, discussed, negotiated with the board of the management. Of course, as we're going to see in the section later, in the next sessions, you can see that a transaction that starts aggressive or unsolicited in the first place could turn to be friendly ultimately, because as a result of the dynamics of the transaction and the execution of it, the parties end up to be in the same place and finally agree terms and conditions for a combination. So between those aggressive unsolicited initiatives and a friendly transaction, there is a number of additional activity that you can see in the marketplace. And as you can see in page 9, top left, there are a lot of activity of activists that are funds that are buying stake in a company listed, and they go public in a very aggressive way with letter written to the board, and they publish then the letter publicly, where they say, dear board, we don't like this, we don't like your strategy, we don't like your profitability, we don't like this, we don't like your for example, lack of environment and sustainability strategy, we don't like the governance, we don't like the level of profitability of your own group. In other words, they highlight element of dysfunction or perceived shortcomings of the company, and they put pressure on the management in order to address it. And sometimes you need a lot of work internally in order to reply to those letters, reply to those issues, because when an activist starts, then it could be an isolated event, one letter to the board, but usually those funds, the activists, are very nasty. They don't give up, they're very aggressive, and they created to coagulate around them consensus. And when a fund has 2%, 3%, for example, then they coagulate and cement interest around it from other funds, and then becomes 5%, 10%, and it becomes an avalanche. In order to avoid that this element of activism becomes so big that creates serious issues, you need to tackle those investors, those requests, and intellectually, you need to properly address all the issues that they've raised, whether are governance issues, whether are performance issues, whether are diversity of and inclusion issues, whether are strategic issues, you name it, quality of the board, quality of the chairman or the CEO, and so on and so forth. In other words, you need to address this point. This business that was totally minor, marginal, a number of years ago, now, as you can see in the slide, counts for 20 billion every year. There are initiatives that are minor compared to the 3.6 trillions in the marketplace, but 20 billion of money that goes into the public market to create activity is a lot, because we are talking about the small stakes that are paving the way for potential M&A transaction and sometimes very hostile activity. And you have a number of funds that they're doing these things for a living, because they take a stake and sometimes they go long in the company, because they, by forcing the board to do corporate actions according to their own indication, they think that they can create value, and that stake can double up, or they can pay the way for a merger, and as a result of the combination, they can make money out of it. So there are funds that are extremely active in this respect. They could be either pure activists, or they can be also hedge funds. Now, I want to engage with you a bit of discussion, more interactive. So far, we are at page 11. Okay. So far, we have said, the impact of the different kind of crises. We have reassured you that in the marketplace, the level of activity remains robust, and we are expecting that the COVID impact will accelerate trends that were already there in the marketplace. And in other words, the level of activity in the economy will be restored quickly and towards the peak once again in a very short time frame. We have said which are the industries that are very active the most in this marketplace, and which are the regions that are very active, US versus Europe. But now, page 11, there is an industry or a segment that are financial sponsors that are, at least last year, very much down, because the volume went down 900 billion in 2019, actually 18, 800 in 19, and 700 in 2020. So the level of activity is already 3 years in a row that is going down. While in an environment where the activity, even during the COVID shock, remains robust and is back accelerating again, as I told you, why the activity of financial sponsor in your mind is decreasing? What's happening in your opinion? I want you to be now, creative, asking me questions. I want to have 10 minutes of debate. Otherwise, I feel alone because I can't see you guys. So what in your opinion is happening in the marketplace, and which are, not only from a market standpoint, but also theoretically, academically, what's happening in the marketplace that can justify, reduction in volume in the financial sponsor? Financial sponsor is another way to say private equities. Come on, don't be shy. Please, Andrea.
Can you hear me?
Very well indeed. I'm so pleased that we are together.
Perfect. First of all, good morning. I think we studied with also Professor Gatti that there is too much dry powder, meaning that it's a market where there is a lot of demand for these deals, we can say, and therefore the prices are too high. So it may be that it's not profitable anymore. This is why the volume is decreasing. Could be.
Okay, Andrea, it is actually true. Stefano is right. The dry powder is in the region of 800 billion. There is 800 billion of equity dormant in the marketplace, ready to be invested. And but that's the symptom why there is dry powder. And you rightly pointed out that the market, the prices are very high, and probably it's not profitable any longer to invest those money. Okay, it's a good way to see. Let me, in your opinion, how the private equity players make money out of their investment? Let me tell you, there are 3 ways. Let's see whether we can, guess the right one. Please, in your opinion, which are the drivers of the return for private equity? How do they make money?
If they acquire a stake in the company, and doing this, they can be either hands-on or hands-off. So they, in some kind of way, can influence how the company is gonna, how can I say, grow and exploit its business. So I'd say these are 2 possible ways. For the third, right now, honestly, I wouldn't know.
Okay, we need to be more specific. It is true that, private equity, when they made an investment, they try to improve performances, okay? Performances of the company that they buy. But let's make a step back. Let's go, for example, to Nexi. Nexi is a payment business listed in the financial market in Italy. They made a number of acquisitions in the marketplace, and by the end of the year, as a result of the closing of 2 main transactions, SIA First and Nets in Scandinavia, Nexi, based in Milan, will be a payment company with a market cap in the region of 20 billion euro. How Nexi grew up that way? Because some sponsors, namely Clessidra, Advent, and Bain, decided together to buy from banks a number of payment business, and then integrating the different acquisition together, and step by step they created probably one of the largest players in Europe. So why I'm telling you these things? Because what happened in the marketplace was banks in Italy starving for capital. They started to sell business that in their mind were not the best owners. They were able to create capital, and they didn't think that there was good business to retain, and they started to sell pieces of the payment business in the pipeline of the payment business to this private equity. Step by step, they sold a number of business. And guess what happened? You take out a business from a bank that is trading a discount to book and is trading at, let's call it 10 times the earnings. And when this business goes into the hands of a private equity, this business is not regulated any longer by regulator like ECB. This business for the market is considered a corporate. And while a payment business within a bank trades at the multiple of a bank, when he goes into a private equity, immediately is a corporate and trades with a different logic, which is EBITDA, enterprise value on EBITDA, like a fashion company, like a telecom company, like an industrial company, like a corporate. So this business in financial services is trading a price earning, goes into private equity, immediately trades like a corporate. And guess what? Trading multiple for payment business in the world are ranging between 14 to 17 times EBITDA. While the same business into a bank means 10 times the earnings. So by changing owner and by changing, the nature of the family of the shareholder structure, you can create value. So the first lesson is private equity makes money through the re-rating. So I buy a company at a multiple that is, for example, 10, and after 5 years, 6 years, I got the same business that is trading a multiple that is 14, 15, 16 times EBITDA. So the first reason why private equity can make money is because they buy a business that has a re-rating in the multiple. Second reason is because while this business in the payment, when they were in banks, they were not able to support leverage, because leverage in financial institution means erosion of the capital structure, and basically regulator wanted to have banks more capitalized, more stronger in terms of capital base. Was not the same when the same business is owned by private equity. And indeed what happened? Nexi bought this business not only with equity, but also with some leverage. So the second source of ways to increase profitability is associated with the additional flexibility that some players sponsor have in terms of use the leverage. More flexibility in exploring more optimal capital structure. So more debt versus equity. So not only re-rating of the multiple, but also financial leverage. Let's see the third reasons. In your opinion, what could be? We said multiple, we said leverage. What else? How can you make money? Let's go back to basics. Which is the most traditional? Yes, growth about what? Because Luca, let me tell you, you can grow in size, bravo, EBITDA. You can grow EBITDA, the earning before interest and tax and depreciation and amortization. So basically de facto, the first level of cash coming out of the business. You can increase the EBITDA because you do the acquisition, but it's not good enough because, if you collect business, your EBITDA is growing, but you pay for it. By combining these things together, you have an increased EBITDA, but then through management, through change of manager, through changing the efficiency, changing the proposition in the business model, in refining the strategy, in attracting new talent, in exploring synergies, and so on and so forth, this EBITDA is growing faster than the EBITDA of the single business. And here we go. You got the third element of the equation. Again, re-rating of the multiple, additional leverage, and EBITDA growth. Let's go back to the financial sponsor market, page 11. Basically, we see that there is a deterioration of the activity, and Professor Gatti rightly so said, there is a lot of dry powder in the marketplace. We have quantified in 800 billion that is not working. We have said there are three elements that are driving the profitability and the creation of return for private equity. So let's see, in your opinion, is it easy these days to have a re-rate of the multiples? Yes or no? And of course, why? Excellent, Ricardo. You know, it is complicated now these days to make a very clear-cut upside in the multiples, because let's face it, the equity market, the public equity market, is at all-time high in human history. When you have a market that is trading already between 15 to 20 times the earnings already in the public market, you know, when you do a transaction as a sponsor and you buy already at that level, because the seller has always the option, either I sell to a private equity or I can go public, you know, I go to the IPO. When they do the dual track, shall I sell to a private equity or shall I sell to the IPO market, and so on and so forth. Basically, when the market is up here, it's very complicated to do a proper re-rating of the business, because you know you're already buying the company at a very high multiple. So that's the first reason we got a market that is very high already. And that's why the dry powder of Stefano Gatti, because it was, you know, I don't want to invest the money where, you know, the main reason why I should have, you know, more return is not there, because the market is already high. Let's talk about leverage. Can you create a lot of value these days with the leverage? Yes or no? Okay, Andrea.
I'd say, as probably all the answer in this subject, it depends.
Yeah.
I'd say if your comps are using a higher leverage than you, maybe you are not optimally exploiting the leverage. While if you have an all-time leverage, you could be subject to a lot of risks. So again, it depends on the position in which the company is and on the...
Okay, Andrea, but how a company, let's go back to Modigliani Miller, how a company can create value through the leverage, in your opinion? And please, other student, help Andrea. It's not an investigation or an exam. It's a discussion. I want to engage you guys.
So if I add more leverage, basically I'm in how can I say, incrementing, increasing the ROE and other ratios, because I'm using less of the money of shareholders to finance the business. So this can lead to multiplied results in terms of profitability and in terms of return on equity.
Yes, but we also know that, you know, the corporate value of a company, the more leverage you put in, the bigger is the part of creditors that they take in the value, okay? And of course, you have a more return on equity that are boosting the multiples. But as we said, this is already very high. You know, it is the multiple expansion through the increase of the return on equity with the leverage is relatively limited. But it's also true that you put leverage in the occasion because you got the tax shield. No, if you have debt, you save money in terms of taxation because there is a tax shield. And indeed, when you do the cost of capital, is not only debt, but also the cost of debt net of taxations. But it's also true that when you don't have inflations in the market, as we believe is the case, everybody wants to have more inflation in the market because we need to have, you know, the interest rate nice and slowly start again, you know, to increase, because otherwise we got deflation and we got a stagnation in the market. With no inflation, you know, debt is very complicated to be repaid because it's hard dollars that you need to pay back to investors, because there is not the effect of devaluation of debt due to the inflations, okay? And also interest rate, when are so low, de facto, the tax shield associated with the cost is getting lower and lower, because when the debt is at 5% and you save money, 50% tax rate, you reduce 2 points, okay? The cost of the debt capital. But when the capital is already 50 basis points, fine. At the end of the day, you save money, but on a relative basis, the savings that you can have through additional debt is becoming more marginal. So what I'm trying to tell you is that also the leverage in the marketplace is important, is there, but is less relevant from sponsor in order to create value. Is there for funding purposes in order to get money, good condition, but is not the real driver for value creation. Finally, the third level, the EBITDA. When you have activity in the marketplace that is becoming more complicated, because some of you wrote down, those are very uncertain times and people stay at bay, okay, investors. But when you have COVID and you have 1 year of opacity in understanding what really is going on in the marketplace, and because you want to know whether this acceleration in digitalization will last forever, whether the behavior of people that will, that are not traveling any longer will stay forever. Basically, can I do lesson forever from London, or when the crisis and the virus will disappear, I can go back to Milan and do the lesson, physically in class. So what will be the behavior of people going forward? So you don't know. I can tell you that I will be in Milan because I do prefer, physical lessons, and I hate remote teaching. But it could be that not all the people will react at the same time. So there is uncertainty. Which are the players that they can see through the uncertainty better than others? In your opinion, a corporate that is a market player in that industry, whether the industry is media, whether the industry is airlines or whatever, in your opinion, that are reading, the reality better than a private equity that is a financial players, or not? There was someone that wanted to ask, questions or give me an answer. So which are the players that are in the position to better understand what could be the new normal, the new world? Corporate player or financial sponsor, in your opinion? Exactly, Daniele. Those that are already in the business, those that are already experienced in other situation crisis, and they can have some guidance from other experiences, some guidance from the past, some guidance from what they live day to day, in and out, week by week, during their own professional activity. So in order to understand what could be the evolution in the telecom business, we can assume that companies like Vodafone, Telecom, and so on and so forth, they can read the trends in the marketplace probably better than others because they are market players. So by definition, private equity, that unless they have already portfolio companies in those business, when there is a big crisis, they get this opacity as an additional level of complexity, additional level of risk, and by definition, they stay at bay. They need to better understand what's going on, and it takes for them more time to adjust behavior, to adjust expected return, to adjust, how can I say, the way they see the business, because they are not market players, they are financial sponsors. And as a result, you have seen activity in M&A going up, but more skewed in the corporate players. So it took a while, but I wanted to share with you why financial sponsor activity deeply is getting sluggish a bit these days, because less re-rating, less attractiveness of the leverage, and lower ability to read through the dynamics of the industry as a result of the complexity that we are experiencing in these days. Okay? Let's proceed. During this, let's go to page 13. Another important event that I wanted to share with you is the increasing role of SPAC. I'm sure that you have read on the press, you have read in a magazine, you have heard on TV, and so on and so forth, or maybe in other courses at the university, you have been exposed to the concept of SPAC. SPAC is a special purpose acquisition vehicle. And de facto, we have in the market, you know, players in the M&A market, which are corporates, there are financial institutions, there are private equity, there are venture capital, there is a bit of activism. We have been talking about this. Now there are SPAC. SPAC are a new player in the marketplace that is becoming very important because let me tell you, between US and Europe now, more than $1 trillion has been raised by SPAC. $1 trillion is a massive, you know, amount of money. And which are the SPAC? Are company that are like a shell with cash, that they get listed with a team that is highly qualified, expert, extremely competent, with the mission to make an acquisition. So basically, it's a company that is born with the purpose of making acquisition, and they raise cash in the first place to be ready and prepared to do the acquisition. And they get listed, and investors are putting money in this company that is empty, is only with the team, ready and prepared to do the acquisition together. And if the acquisition does not materialize, the money will be repaid back to investors within a year. Really much depends on terms and conditions, but usually it's 1 year. You have 1 year to make the acquisition that you promised me to execute. And this management team, let's call it the sponsors, they're coming usually from the industry. It could be financial institution, it could be media, it could be telecom, and so on and so forth. And they announce that together, you know, a chairman, a CEO, and a professional team, they are raising, with the help of a bank, you know, they're raising money in the institutional market, let's call it 500 million euro, to make an acquisition. And usually you get an average size of these investment that are, you know, in the region of 300, 350, $400 million. So SPAC raise money, $400 million. And what they do is when they find a target, they agree terms and conditions, they buy the target, and as a result, there is a combined entity that goes directly, naturally into the public market. So the company that is being bought, rather than going to the market, IPO directly through the IPO process that we have been analyzed together, okay? There is an alternative. This target can be acquired by SPAC and goes, as a result, into the marketplace because the SPAC is already listed. The usual structure of a SPAC, no, Lucas, they don't know yet because that is the job of the operating team. The operating team usually when you create a SPAC and you announce it, you say, good morning, dear market. Today, this team has created the SPAC. The name is Massimo. And this SPAC wants to buy company in the, let's call it, sneaker business and in the fashion segment of the market. Fine. And we have raised 400 million euro in the marketplace. We will be making acquisition within a year. Otherwise, we give the money back to investors. And when we raise money in the marketplace, we also have created a core group of investors that is called Private Investment in Public Equity, PIPE, and we raised an additional 200. As a result, they got 600 million euro, 400 the SPAC, 200 the PIPE, and they can make an acquisition. When they find the target and the target agreed to be sold, the new company usually is owned by, let's call it 60 to 65% by the shareholders of the target that are selling the company, but de facto they are reinvesting a portion of the money in it, 65%. 14% is a SPAC, and the balance, 14% is the PIPE, the core group of shareholders, the selected shareholders, and finally the SPAC. So de facto, the target will be bought by the SPAC and get listed immediately through the acquisition. Shareholders of the target became shareholders of the combined entity, and the shareholders of the SPAC are the shareholders of the new entity, which made the acquisition. Okay? So they don't know the name of the SPAC in the first place, but they trust the team that are competent enough to find the right opportunity. And when you have these businesses that are representing almost 1 trillion, so there is already 1 trillion of money that has been raised in the marketplace, ready and prepared to be deployed, you can tell that this year, the level of activity in the M&A market that in the first quarter is up already 5 to 10%. Let's assume that there will be, finger crossed, 4 trillion. A good portion of those 4 trillion will be made by SPAC. So what we said, there is more corporate activity, and we have a talk about the industry that are active the most. We have seen sponsors that are going down a bit for all the reasons. We have seen activists that are increasing the activity, and then a new rising star that is coming up in the marketplace, which is the SPAC. As you can see, a lot of things are happening. And that's why I don't want to hear students say, life is complicated. It's complicated to find a job. It will be complicated because banks are becoming less and less relevant in the market because there is a level of concentration. So what I'm telling you, yes, there are less investment banks, but we are seeing the boutique. Yes, there are less activity, less jobs available in investment bank, but we got the activists, we got the SPACs, we got the private equity that, trust me, they're not going to sleep together forever. They're going to stay very laser focused on how to redeploy the money and try to adjust their own expectation in terms of return, or to be more creative on what to do with their own portfolio company. But sponsor will be there, venture capital. The M&A market is always big, extremely professional and complicated, but extremely big and full of opportunity. That was the reason why I wanted today to make and share with you those thoughts, because it tells you a lot why it's important to do a course in M&A, not only for valuation, not only to understand cost of capital and why the strategy is important, but because it's real. It is the most important product that an investment bank has, but also the most important moment in a corporate history, because every time there is a transaction, there is a fallout of events that are extremely important. The company gets listed, shares are traded, the bond are traded, you got the integration issues, you have information technology integration, you have synergy, job that are destroyed in one side and job created on the other side. Every time there is an M&A transaction, the world of the company that are involved is changing dramatically. And when there is a change, there is a lot of opportunity. I will stop here, but I wanted to allow you to have, other 5 minutes, 10 minutes, whatever, if you want, of course, for questions. Yes, Lucas. Let me give you an example because it is public domain. We have an activist that is called Bluebell that has been writing is on the press, is a public domain, has been writing to the board of directors of UniCredit, and they have articulated that the letter is saying, dear UniCredit, we are very we want to have a board that is more international, more equipped, and better prepared, and so on and so forth. So we want to have an upgrade of the board. And as you can see, UniCredit is working hard in order to present a slate of director composition that is good enough. Then they said, second point, we are against the acquisition of Monte Paschi because blah, blah, blah. And they articulated some argument why UniCredit shouldn't do Monte Paschi transaction. And then they were claiming that, the chairman of UniCredit was not independent enough. So they listed a number of issues. And what they want to achieve is, if they are invested in UniCredit, in their opinion, by forcing the board and UniCredit to do those things, if they do it, they will create more value. So they are minority investors that are aggressive enough, active enough to try to force the board to change course of actions in order to make money out of it. And what they try to get happening in the marketplace is to coagulate other funds that, along with them, they can create a front. And the bigger is the front, the higher is the probability that UniCredit will, try very much to do the things that they are asking for. So activists, this is an example. This is a fresh one that happened in the marketplace, but you got in Danone, the activist was against the governance of Danone. And ultimately, the chairman and the CEO of Danone resigned because they wanted to have a change. So the activist is a public market investor that aggressively and in an unsolicited fashion try to change course of action in a corporate that can pay the way in change of governance, but sometimes in an M&A transaction, or put in play the company itself and to be available as a target to other players. So activist is always a preliminary step to some corporate action that you can see in the marketplace. I hope that I reply to your questions. Excellent. Any other questions? I don't think that there will be, at least in the short term, mergers between European banks, because we don't have yet European Banking Union. So the synergies between banks in different jurisdictions in Europe are not very easy or very clear to achieve. So in other words, if there is a merger between, I don't know, Intesa and Santander, or between Santander and BNP Paribas, it's not clear to me when they can create value, rather than increase complexity, becoming bigger, the regulator will ask for more capital, more rules, more compliance. So more duties and less value. While it's totally different in US, because when you put together, two banks in US immediately, because the culture is the same, the language is the same, the banking system is the same, the regulator is the same, the capital market is the same. For all these reasons, a merger between two banks in US, as it happened, created a lot of value. Let me give you an example. JP Morgan has a 10% of deposits, actually 11% of deposit market share in US, which is a market that in size is very similar to Europe. The biggest European bank is a Crédit Agricole, that in terms of deposit has less than 1%. So you can tell that the critical mass in US pays off, and JP Morgan, which is the most profitable bank in the world, has a 10% of his own domestic market, which is as big as Europe. The equivalent in Europe is not even comparable to JP Morgan, because Crédit Agricole, as I told you, has 1% of the deposit market share. And when you see cross-border in the financial institution market, it looks cross-border, but actually is very domestic, because UniCredit was rumored to be interested in Commerzbank. It looks like a cross-border, but ultimately is very much driven by domestic, reasons. Because, as you know, UniCredit has HVB in Germany, and by combining the two banks, de facto you combine HVB with Commerzbank. So it's a domestic consolidation rather than a cross-border. So to see cross-border deals in the banking system will take a while. Thank you. So if you don't have other questions, I will stop here, and we'll see you guys, I think, in a couple of weeks, and we'll start talking about M&A process, and we started with the Kandi case, the sale of Kandi to Aier in China, talking about the M&A process on the sell side. So thank you very much for your time. I hope you enjoyed the lessons. I try to do my best blindly, and have a nice day and enjoy your break for Easter. Thank you very much.